Amid mounting trade strain with the United States, Chinese manufacturers are retreating from global markets and redirecting their focus inward. Yet what seemed like a strategic fallback is rapidly turning into a domestic economic standoff. Instead of relief, these businesses are encountering intense internal competition, with razor-thin margins and unsustainable pricing tactics defining the landscape. Once exporting powerhouses, many companies are now forced to offload products at home for next to nothing. Walk into any local apparel shop, and you might find jackets going for 19 yuan, barely $2. Surprisingly, the quality isn't terrible, often including 40% cotton. But behind these attractive tags lies a bitter truth: these items are sold at a loss. Retailers, saddled with high operating costs, are resorting to cutthroat pricing and throwing in freebies like phone charging, hemming, and storage just to draw foot traffic, and it's not just clothes. From trousers priced at 15 yuan to socks for just a single yuan, the flood of cheap goods is staggering. The domestic market, far from being a lifeline, has become a brutal arena where businesses slash prices below cost to stay relevant. Analysts now question whether internal demand can truly support such volume, or if the market is imploding under its own weight. Enter JD.com, China's e-commerce giant, which recently unveiled a plan to redirect 200 billion yuan worth of goods once destined for export into the domestic economy. On the surface, this may seem like a timely intervention. But in reality, it's more like tossing dynamite into an already fragile market. With domestic shelves already groaning under oversupply, injecting even more products could spark a collapse in pricing, and with it, profitability. Consider this analogy: in a town with 3 steady breakfast joints, a corporate chain swoops in offering the same food for half the price. The small businesses can't keep up. Similarly, JD.com's bulk imports may overwhelm mom-and-pop shops, which can't compete with large-scale production costs and supply chains. If other conglomerates mimic JD's strategy, the domestic market may spiral into chaos. At local trade shows, the mood is telling. Exhibition halls, once buzzing with eager buyers and sellers, are eerily quiet. Companies dangle extreme markdowns, hoping to spark interest. But foot traffic is dismal. The margins are so tight they barely cover costs, leaving sellers in a constant state of strain. With little to show for their efforts, all of this plays out under the shadow of rising tariffs. The US now slaps up to 245% duties on Chinese imports, while China has responded with a 125% rate. Textile manufacturers, in particular, are floundering, with orders drying up and factory output stalling. The government has responded by urging a pivot to domestic consumption, positioning it as both a solution and a patriotic duty, yet the ground reality suggests this pivot is hitting a wall. Consumer spending is cautious, weighed down by economic uncertainty and slower growth. While some export businesses are trying to court domestic buyers via expos and partnerships with large retailers, most find the home market too crowded and unforgiving. In Shanghai, one major domestic trade fair laid bare the brutal truth: vendors outnumbered customers, discounts abounded, and optimism was scarce. The idea that the domestic market could serve as a buoy is quickly fading. With shrinking margins, falling demand, and oversized players dominating, many smaller firms are now choosing to wait out the storm rather than dive into treacherous waters. What was once seen as a fallback strategy has now exposed the limits of China's domestic capacity. The trade war may have started overseas, but its fiercest battles are now being fought within China's own borders. Chinese entrepreneurs are increasingly realizing that the global trading climate, turbulent as it is, still offers more promise than the saturated domestic market. Some factory owners report that American clients are encouraging them to relocate operations outside of China, prompting a wave of interest in Vietnam, a country inching closer to a zero-tariff agreement with the U.S. If such a deal materializes, it could lure major international brands to shift production there en masse. Unlike other global players who might hesitate before retaliating, China's tit-for-tat tariff approach has been met with harsher U.S. responses. The result? Private exporters in China now face mounting pressure, and even companies serving local industries like packaging are struggling, since their survival is tied to orders from global traders. China's domestic demand, long touted by the government as a growth engine, hasn't been able to pick up the slack. Despite official campaigns promoting internal consumption, business owners argue that too much emphasis on the home market may end up backfiring. The reality is stark: domestic production is plagued by serious overcapacity. Behind the illusion of bustling factory floors is a harsh truth: many facilities are barely staying afloat and rely heavily on foreign orders to stay in business. Multiple attempts to pivot toward the local market have ended in red ink. Many firms lose money year after year trying to sell domestically. Industry insiders predict a wave of closures by year's end, and signs of distress are everywhere. Hiring is easier now, not because of economic growth, but due to layoffs. Factory rents have plummeted. Some locations now charge less than half of what they did a year ago. There's also growing fear that America's trade stance might become contagious. With the U.S. clearly committed to hiking tariffs, other nations might follow suit. Some estimates suggest new tariffs on Chinese goods could rise as high as 50% in countries aligned with Washington. These developments have triggered major disruptions at Chinese ports, particularly in sectors like apparel. With containers piling up and goods stuck in limbo, many exporters are turning to live streaming to offload stock directly to domestic buyers. At Shenzhen's port, vast plots under redevelopment are cluttered with cargo that can't move. Every day, storage fees stack up on unsold goods. Some business owners are resorting to drastic measures. Garments once retailing for thousands of yuan overseas are now going for as little as 200 yuan in desperate clearance sales. Each container can hold upwards of 30,000 items, and there are countless such containers just sitting idle. Even if exports resume, the cost of doing business, logistics, storage, delays, means many firms will still operate at a loss. Online influencers in China, particularly those focused on finance, have begun warning that mass layoffs and production cuts are inevitable. If international orders dry up completely, factories will be forced to flood the domestic market, only to find themselves trapped in a brutal price war for ever-shrinking profits. The local market, already stretched thin, simply cannot absorb the volume. On April 11, China made a surprising announcement: a new round of retaliatory tariffs would be raised to 125%. But with a caveat: it would not escalate further unless provoked. Just a day before, officials had signaled a hardline stance. This sudden softening suggests that Beijing may be running out of leverage. In response to U.S. pressure, China is also looking outward, to Europe and Southeast Asia, for economic lifelines. But while Beijing pins hopes on Belt and Road partners, many of those countries are increasingly aligning with the U.S.-China's best-case scenario. Replacing Western markets with alternative allies looks shakier by the day. Meanwhile, Washington still holds a powerful deck, pushing Chinese firms off U.S. stock exchanges, freezing dollar-denominated bond payments, halting tech exports, choking off talent exchange, and possibly organizing coordinated sanctions with allies. For China's traders and manufacturers, the road ahead looks less like a pivot and more like a minefield. The United States continues to steer global commerce, working alongside more than 70 allied nations to gradually push China out of the world supply chain. What began as a campaign to address trade imbalances under President Trump has now evolved into a full-blown economic standoff. Though Chinese state media maintain a firm posture, the consequences for domestic industries have been far-reaching. Exporters are hurting, but so too are the auxiliary firms that support them. In manufacturing hubs like Guangdong and Zhejiang, a wave of factory closures has been triggered by cancelled contracts and swelling inventories. Orders from overseas buyers have shrunk to a trickle, leaving many businesses shouldering massive losses with little relief in sight. This downturn is sowing a sense of gloom throughout Chinese society. Online forums in China have taken a bleak turn, with netizens joking about surviving on bark. Both the young and old are expressing anxiety about the future as production slows, economic momentum stalls, and hope dwindles. Analysts warn that without swift and strategic intervention from Beijing, things could spiral. Experts abroad believe the deep-rooted rivalry between Washington and Beijing offers little room for compromise. The window to de-escalate is closing fast, and the next 3 months could determine whether a full economic split becomes inevitable. If neither side yields, China's exports to the U.S. could plummet to near-zero levels. In contrast, American imports from China may be more easily replaced. Trump's proposed 245% tariff implies that selling $1 worth of Chinese goods would cost an additional $2.50 in duties, making trade prohibitively expensive. Last year, America imported nearly $439 billion worth of Chinese goods while China took in just $143. $5 billion from the U.S., a trade gap of about $300 billion. With those new tariffs, the U.S. could rake in over $1 trillion in duties compared to China's modest $179 billion, revealing a lopsided advantage in Washington's favor. While such a scenario might shift trade dynamics, economists caution that both nations would incur substantial economic wounds. The U.S., however, has the flexibility to switch suppliers. China's top exports to the U.S., electronics, machinery, furniture, toys, and plastics, are all sectors where alternative manufacturers in India, Vietnam, or Mexico could step in. China might attempt to route exports through Southeast Asian nations, but this workaround would be costly, time-consuming, and under the watchful eye of American regulators. Relocating manufacturing hubs outside of China could also lead to widespread factory shutdowns at home, resulting in massive layoffs. China's own imports from the U.S., valued at about $143.5 billion, include critical categories like fuel, machines, medical devices, and oilseeds. While Beijing might find alternative sources for some of these, high-end medical technology and aerospace equipment remain difficult to replace. Certain items, like commercial aircraft, pharmaceuticals, and agricultural seeds, must still come from American suppliers. Once tariffs climb beyond 50%, they start acting less as deterrents and more like roadblocks, making goods effectively unsellable. Observers say that Trump is leveraging tariffs not just for economic effect, but to force China into an uncomfortable corner. Chinese leader Xi Jinping, however, cannot afford to show weakness. With both sides escalating duties, there's growing concern that further increases will become futile. Yet the strategic advantage appears to remain with Washington. The U.S. remains China's top export destination, and a nearly $300 billion trade surplus underscores how dependent Beijing still is on this relationship. Should the U.S. take another hardline step, the ripple effect in China could be severe. Washington's task over the next 90 days is to secure new trade partners who can plug the supply chain gap. If successful, America may come out of this conflict largely unscathed. In the short term, American consumers might see price hikes, but those could ease as alternative suppliers emerge. For China, however, losing even the last 15% of its export volume to the U.S., after years of trying to diversify, could spell disaster. Millions of jobs hang in the balance, and Beijing's room to maneuver is narrowing by the day.